and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, Indian market is seeing a volatile year. Inflation is in the air. Rate hikes are happening. So is there a way to protect your portfolio? What are the secrets of investing in such volatile markets? Well, joining in to discuss all this and much more, I have with me a very special guest today. Mr. Vivek Mashrani is joining us today. Well, he's the founder of TechnoFunda Investing and also an author of his first book, You Can Compound. Congratulations, Mr. Mashrani, and thank you so much for joining us on ET Markets.
Thank you so much, Tanya, for having me here, and it's always a pleasure to speak on your channel.
Mr. Mashrani, let's start with the secrets and the strategies. After all, your book is all about that. So what is the secret to protect the portfolio in such volatile markets, and also the strategies that investors should follow at this point in time?
Yeah, so basically, I think this has always been the case, right? So whenever we are investing, I think the risk management and overall structuring the portfolio in such a way that we don't lose it all, even one pocket of the market is falling, right? So I think the secret is, there is no secret as such. It's just risk management is the first principle which all of us should follow, even before, thinking about buying any stocks. But if you think about the overall strategy, what I'm following, I generally create a portfolio which is called core and satellite portfolio. And even in my book, I've covered this in depth, So 70% is the core portfolio, which is like, into core compounding companies, which can compound their cash flows year on year, and they can reinvest their capital into the businesses. So these are kind of companies which, your Page Industries of the world, your Bajaj Finance of the world, Asian Paints of the world, where even if, there is a temporary downturn, it doesn't affect you over long term. So you really know that these businesses have proven themselves. These are like having longevity. They are having some competitive advantages, and temporary fall should not affect you in those portfolio companies, core portfolio companies. Now, having said that, there is a 30% remaining, portfolio which I use. It is called satellite portfolio. So this is where basically you follow, having allocation during the market when it is achhe din or good days are there, and when there is bear market, it automatically goes into cash. So it's like a predefined strategy which I'm using, so that when there is a fall, you first get opportunity to deploy cash, because that's the biggest problem. Most of the investors, when the fall is happening, they don't have cash to invest, despite they knowing that market is cheap and the valuation are much reasonable. So that is the blend which I am following, and I think for investors, it's probably the best time to up the game in terms of researching companies and finding a lot of interesting names which are coming through.
Absolutely. And what is your take on the valuations? Given the fact that the valuations are now more reasonable, do you think now is the time to be greedy in stocks and start buying aggressively?
Oh yes, so I would say it should be time to be greedy and be aggressive in terms of research. I don't see it's a no-brainer price yet, but it's still, the froth has to an extent gone away. So it's probably we are towards that fair value kind of valuation, and particularly in a lot of small and mid-cap space, I think the days are going to be very, very interesting. So it's definitely time to up the game and be more aggressive in terms of research and finding those pockets where we can, actually compound and probably, make like 2x, 3x in 3 years. That is the kind of time we are in. I would say, in terms of deploying, we can still deploy staggered way rather than going all in and being too aggressive in deploying cash.
Okay. And also you tweeted about this as well. You said that the allocation is the key. It remains one of the most underrated principles in investing. So what should be the ideal asset allocation strategy?
So the allocation, was in terms of two parts, so first is equity allocation. So if as an overall portfolio, right, say somebody has 1 crore worth of net worth and they're putting 10% in equity, and even if they become like 15% CAGR for next couple of years, it doesn't move the needle at a portfolio level, right? So that is the first thing. And the same principle also applies at a portfolio level. So say, for example, you do your research and we find, good companies which can compound over next 2-3 years, and if we make say 2x 3x in that company by doing right research, But say if the allocation to that company is only 1% of the overall equity portfolio, it doesn't move the needle, right? So the idea is when we are researching and we are getting these winners, and we will know, of course, the winners in the hindsight, because that's how equity is, right? That businesses will perform, and then the stock prices will also start going together with the business performance. So the idea is when we know that the business is improving, we should keep allocating more and more, basically averaging up in the businesses which are performing and cutting our losers. So even if we might have thought that this is a great company, but then the performance is not the way we wanted to, then we should cut down those companies. So riding the winners and cutting the weeds and allocating more to your winners. That's as simple as it can go.
Absolutely. And where do you see value in this market? I mean, which themes are you bullish on, especially after the recent correction?
I try to see pockets of strength where companies are actually outperforming Nifty or underlying indexes, right? So a lot of people do the reverse thing. Like if Nifty has fallen 30%, they try to hunt for companies which has fallen 50, 60%. And probably, those companies are the one which are losers and they are not performing, and that's why market is beating them down even more, because they might have got people into euphoria, but then they now realize their mistake. So I try to find pockets of strength, and currently if I see auto as a pack, if you see it's outperforming the index, so that is where I'm getting interested and trying to do my research and seeing where there are pockets of opportunities lying. And even if you see the CNX auto index, it's almost like hitting new highs when the market is falling 20-30%. And a lot of auto names, like if you see Eicher Motors, Lumex Auto, 10s, 20s of names are actually showing strength and almost nearing their highs. So that is where I get interested. And if you think about, they did not participate in their last bull run also. They were like pretty much slow in terms of participation, and now the pockets of strengths are visible.
Right. Also, Mr. Mashrani, what about the newly listed and new age internet companies? I mean, share of these companies have corrected significantly amid the market sell-off. So your thoughts on the same?
So I think, when something which is emerging comes out, there is always good businesses out of that pocket and some euphoria created around it. And it is not happening for the first time. We have seen in 2020 in tech stocks, IT stocks, right? A lot of companies came and just renamed itself as .com, and they were getting re-rated. Same thing happened, I think, in last 2 to 3 years. There are genuine platform businesses which are able to create those network effects and then create that economies of scale, which is unbeatable. And there is a typical thing in these businesses, that these businesses have winner takes it all scenario, right? So if you are really able to grow and have that network effects in place, you can displace all your competition. So rather than looking this space as a whole, we should see pockets where businesses are really resilient and they are able to scale up and they are able to displace competition, because there will be always some of the platforms which are getting killed because of somebody which is very, very strong in that area and they are not able to scale up. So that's where we need to see. And some of the businesses, because of the IPO euphoria and everything, they got listed at insane valuation. Some of them are duds, some of them could be really interesting, which we should be watching out for.
Absolutely. And also over the past 6 months, we saw war, rate hikes, rupee depreciation, FII selling. So do you think that these factors will play a major role in the second half also? And where are the markets headed according to you in the near term?
Right. So I think, there is always a bull market somewhere and there will be always fear and bad news anywhere in the world, right? So somewhere something is, there was Turkey, then there was Brexit and all those things every year we have been seeing. And irrespective of that, the Indian markets have been kept on growing because there is underlying growth, right? We are a country of consumers. And I would suggest, rather than looking at 6 months, which nobody knows, right? Things can go haywire in short term, but we should focus really like in next 3 years, which are the companies which can compound like 25-30% CAGR and double its earnings, right? That is where we should be focusing our overall energy. But if you ask me, I think in global scenario, in terms of rate hikes, I think inflation is for real. And FII selling is just very, very minuscule. If you see the broader context, out of around $600 billion which has been invested in Indian markets overall, the outflows have been still peanuts. So it's not that FIs are just pulling out everything out of India. It's just that their normal cycle, which is there of pulling money, that is what is reflecting in Indian markets. But I don't see it as a structural shift of FIs which is happening. It's more like their ongoing process of profit booking and taking out some money off the table, which is happening right now.
Absolutely. And lastly, before we let you go, Mr. Mashrani, what would be your advice for all the investors on Dalal Street? I mean, any mistakes that they should avoid at this point in time?
What I've seen is last 2 years, we have one of the highest participation in Indian capital markets, right? So 50 years since our independence, we had around 3 crore investors. And last 3 years, we have added almost like 7 crore investors, right? So on BSE right now, we have 10 crore registered investors. And they have never seen a major bear market. And we are not even there in terms of bear market, right? The severe bear market was like COVID, which was again a small flash for 2 months. But then we had 2008, we had 2013 to an extent. And then we had major bear market in mid cap and small cap in 2017-18, when a lot of stocks corrected even 60-70% in small and mid cap space. So the idea is, they might think that, the traditional asset class like FD and real estate is where the money is to be made, and this is not the space to be in. My advice would be, stay in the game, because when we feel that we should be getting out of the equity is actually the time when we should be investing in the equity. It always is the case. When IPO and euphoria is there, we feel like we should put more and more money, and that is where the risk is actually high. And when the market is falling and the valuations are cooling off and our returns are negative, we feel that we should be getting out. That's the time to up our game, research, and find out opportunities, right? So my advice would be stay in the game, because if you are in the game, then only you'll be able to play the game and make money and win out of it. So don't get discouraged, learn the effective way to compound and, go for it. I think the next decades is of India, I think.
Absolutely. Stay in the game. That's the word coming in from Mr. Mashrani. On that note, thank you so much for joining us on ET Markets today. Thank you so much for sharing your thoughts. Thanks a lot.
Thank you so much, Tanya, for having me. It's a pleasure and lovely talking for all the investors who are watching this. Yeah.
Thank you. Thank you so much.